Hello everyone, my name is Yaroslav Burchenko and I'm a market analyst at Olymp Trade, and here today in this video I want to tell you what the most common mistakes are in trading, and then we will take a closer look at an event called random reinforcement and how you can train your brain to properly analyze any given situation. But first, let me give you the easy and important stuff about trading. So a real quick roadmap for those of you that want a trading plan. Well, what you need to do is you need to have an edge in the market. So let me show you guys real quick what that edge looks like. You need to find a financial asset. You need to find a part of the market that maybe you know more than other people about. Say you work in the oil and gas sector, or you're aware of, say, electricity prices and how Bitcoin mining correlates to the fluctuation of electricity prices. Say you have an understanding of technical analysis, or you have an understanding of reading volume analysis. So any kind of edge that you may have in the market is something that you definitely need to pursue. Now, moving on, you need to have good reasons to enter the trade. So after you find an edge, after you find an asset, you need to look for several reasons to enter the trade and for them to overlap each other and to give you an even stronger reason for the trade. Then the next part is why you will exit the trades. This is the next most important step you need to figure out in your trading plan, is reasons for exiting the trade. It's also very important that you have really good reasons to exit the trade. And last but not least, this is what we're going to spend most of our time talking about, is record the trades. You guys, come on, record the trades. This is your trading business. You need to really put in that extra energy to document your trades, to document your emotions, to find the reason why they're not working. When you document the trades, you will have a reason, you'll have a way to quickly understand when the market is not, behaving as it normally would. So the biggest psychological mistake and how to correct them. This is my next set of clues I'm going to give you guys. Avoid emotional investing. Don't invest when you're feeling, don't trade when you're feeling down, when you're feeling sick, after you went through a series of losses. Don't try to win the money back. Oh, I can't explain how many people fall into this trap. When you lose some money and your next trade, you're putting in more money. You're taking more risk when you are emotionally unstable. So don't try to win back that money, and get rid of fear. If you have a good working strategy, don't let the fear consume you. If you're afraid of opening your next trade, then you're probably overtrading. You probably lost too much money that's comfortable for you. And so don't trade off the fear. But if you have a good working strategy, don't be afraid to push that button. And don't fall in love with a stock or an idea. I know I first said pick one stock or one financial asset to trade. Don't be in love, say, with Apple. Apple's coming out with a new iPhone, or Tesla's got that new Model XS. You love the company because they're green, they want to help the world, they're doing something innovative and new. Don't fall in love with the stock or company. Remember that the market and price is always right. That you can never, you can never say that, oh, that valuation is wrong. It's always right. And so go with the flow. Now, attention, this is the number one biggest mistake all traders make. This is the number one mistake. So guys, what is it? Pay attention. They give up and they start to mistrust finance and investing. People give up on trading, and then for the rest of their life, they think about trading and about investing in the stock market as something bad, as something unreliable, untrustworthy. When all of the rich people in the world, and I don't think that I'm overexpending when I say all people that are rich are invested one way or another in either the stock market or a business that is tied to the stock market, or that has made an initial public offering in the stock market, that is listed in some stock market across the world. So the number one mistake that people make is they make so many mistakes, they lose a lot of money. After they lose so much money, then they feel that they've been cheated. They felt that they've been swindled, and so they start to mistrust any kind of trading or investing sort of activity. Whereas the opposite is true. The opposite in life, the more time and effort you invest into learning about trading and learning about stocks, even if you don't become a multi-millionaire and people are applauding you on the sidewalk, you still have learned an incredible skill. You learned about analyzing and reading graphs. You learned about analyzing the financial information in an earnings report. You learned about risk and reward and controlling your emotions. The path of a trader is wide, and it's very, very interesting. So, what is the number one thing you can do to increase your chances of success? Keep a journal. Take notes on your trading as if your business depended on it. Do it. Just do it. Okay? One interesting and emerging topic that we have in the trading sphere is the practice of random reinforcement. Now, I'll tell you what this is. This is a scientific term that doctors use. Random reinforcement relates to practices that occur when a trader misattributes some of a random, say, outcome to their own strength and prowess as a trader. And so when it doesn't exist, you know, when there's nothing that made that trader win money, but he greatly believes in his own, you know, advancement. So the key takeaways when what we're going to be talking about here is that random reinforcement is an arbitrary event that you want to qualify or disqualify. Basically, it gives you an illusion that you have some skill, or it gives you an illusion that maybe you lack some skill. And the outcome just becomes skewed in your head. You don't understand why something happened. So random reinforcement occurs when traders are rewarded by random in the market for behaviors that are not, say, productive or that are not their own doing. Now, because of random reinforcements, traders may grow overconfident in their ability, even though it's unfounded. So, how does a random reinforcement affect us as human beings? Not only as traders, but as human beings. The market, as it turns out, occasionally rewards bad habits and punishes good habits because of the random nature of the market, or sometimes the staticky noise that you feel when you're trading. There is, this can be especially bad to, say, a new trader who has absolutely no trading plan, no idea what he's doing, and they win their first early few trades, right? That's dangerous because a trader can then, you know, fall in love with his own ability to trade and put more and more and more money on the account that he was not planning to do. So it can hurt veteran traders as well, this random reinforcement idea, because those who have lots of experience and then go through a series of losses, and then they come to believe that they no longer have the skill for some reason because the market gives them 8 or 9 losses in a row. So random reinforcement can actually make long-term bad habits in your trading that are extremely hard to break. It's like similar to gambling addicts. Those who keep playing and keep playing because they just want to win and they just want to stay there and continue. But of course, they're losing their money over the long term. And a talented card counter may likewise also experience a significant drawdown, abandon his proven card counting strategy, and give up the edge back to the house, back to the casino. So the concept of random reinforcement is hard to grasp for certain traders, but understanding it can be the difference between actually improving as a trader or simply believing when we're improving when we're actually not. So the best way to understand this is through a few examples. Let me give you guys one example, relying on randomness. Let's take this example of, say, Alex as a trader. You guys give me one second, I'm going to switch the screen. So we have, say, trader Alex that is that he's got a business background, and he starts trading, and he's looking for news. He watches the news, right? He's got his he knows all about metals. He knows all about stocks. He knows all about the oils and cryptocurrency. Still, Alex has not traded so far personally, right? He's downloaded the platform. He's had a look at some of the stocks, but he thinks that he has what it takes to be a good trader. And so far, Alex has not written down any strategies or any trading methods, but Alex has opened up a trading account. And with the trading account, he believes that the background knowledge he has about business and about reading the graphs, that'll be enough for profitable trading. Pulling up these price charts right here, Alex is looking through the stocks that are now trading in the earnings season, and Alex sees a stock ticker that looks very bullish. It is very, very positive. Alex is very positive that the stock will go up, and so he makes a buy trade. Let me just, for the sake of the trade. So the U.S. markets are not open yet. Indices are, though. So we're looking at, say, the S&P 500 that could be reaching, say, higher. And Alex opens up a buy trade for $200, and he goes to lunch. Alex opens up this trade, is certain that it will go in his favor, goes back to lunch, and the stock continues to rise while he's at lunch. And after lunch, Alex comes back and sells the shares of the company that he bought, or sells the trade in the S&P that he had. Let's pretend that was a good trade. Let's pretend that, for the story's sake, that I made some money. And Alex makes another trade, say, in another direction, and ends up with more money. He ends up starting to feel self-assured, and he's kind of patting himself on the back and thinks that, hey, he's got it. He's got a knack for trading. Honestly, guys, this story is about me. So I started trading just like this. And when analyzing the situation, experienced traders, they'll notice a few things right away that could lead to a shortening of Alex's career. And the main problem is that a handful of successful trades are not good enough samples. Remember that we are statisticians. We deal with statistics, and there's not enough there's just not enough samples to understand if a trader will be profitable in the long run. And so let me switch back to the main screen, guys. And so a trader, for Alex in this case, he needs to make sure that they do not fall into the trap of believing that the current methods, which are still untested and unproven, will bring overall long-term success. So Alex needs to do some back testing. Alex needs to test some of his theories of the market on a demo account first and be profitable for several months before even attempting to put any of his money on the line. So danger lies in refusing market guidance or methods which are self-created but provide someone else because they're provided by someone else, because this initial untested method is believed to be superior based on the trades that you've done. But the trader can begin to think very strongly that if it worked once, it'll work most of the time, and the markets will not reward this kind of illogical and wrongful thinking in the long run, and they may reward random and unplanned trades some of the time, but not most of the time. So this is what you need to plan for and focus on. So let's move on to the next example just to keep the ball rolling. The next one is about abandoning a really good strategy. So say myself or one of my colleagues, we give you a good working market strategy that we have back tested and showed several examples where it works. So let's now go back to the same person, say Alex, that has now been trading in the markets for some time, and he realizes that he's approaching the market with a well thought out, well written out, and thoroughly researched plan and he wants to stick with it. And the early problems is that first, Alex was overcome. The first problem Alex has overcome. Now he's back tested. He's got a solid trading plan. He's been approaching the market in place for several years. He's disciplined. He's worked well with it over the last 2 years, and it's made him money over the last 2 years. So now Alex is facing another problem. Despite all of the success that he's had over these 2 years, Alex has now come up to a line of series of several bad trades. Let's say 9 trades. Alex has made 1, 2, 3, 4, 5, 6, 7, 8, 9 bad trades. He's in the negative for the week. He's in the negative for the month. And he's starting to scratch his head, and he's starting to wipe the sweat off his brow. And he's thinking that the method is no longer valid. And in doing so, Alex ends up using an untested, unproven trading method with the similar missteps that he did in the beginning. The problem with this situation that I'm explaining to you guys is evident because Alex abandoned the tried and true method, which was successful, in exchange for an unproven method, something that, put Alex right back into square one, into the beginning. And besides Alex being successful in trading for several years. So why did this happen? Well, Alex failed to realize that while randomness can create winning streaks using a flawed trading method, the randomness can also create a string of losses when you have an excellent trading plan. So it's very important to make sure that a trading plan is solid, and you need to make sure that if you're going to abandon it, it's actually not going to work anymore. Like, say, some sort of new algorithmic trading came out, or a certain trading law or rule in your country that forbade your working strategy from working. Like, that's a good reason. You could drop a profitable trading strategy for those reasons. Other than that, if you're having a series of losses, you need to address your journal. Step back from the situation, address your journal, and look, the reason to trade, the entry point, the price fluctuation, the market sentiment, what is the S&P 500 doing, what is the US dollar doing, what is the price of gold, what is the price of oil. Like, consider all these factors in your trading journal. You should write them down in your trading journal and then analyze them to see why your trades have not been working. And if all you need to do is take a break, if you need to step back from the computer because today is some sort of absurd volatility that takes price both up and down to knock out your stop losses or to pierce your FTT positions, well, then do it. You need to take the break. But again, only the documentation, only the active analysis of your psychology, of the market situation, of your trading strategy, only that thorough analysis can bring you to that level of advancement where you stay away from failure and obviously stay away from giving up on an activity that can feed you throughout your entire life, right? The first 5, 7 years, if you're exceptionally slow and exceptionally lacking discipline or lacking consistency, it could take you 7 years. But in the end, again, there is no time frame on your life as an investor. We have the likes of Charlie Munger at 92 years old being an investment manager for several billion dollars. So of course, it's a good trading path to be on. It's a great life path to be on. So let me answer a few questions you guys may have, because this is a recorded video. You guys cannot ask me them live. So why does random reinforcement happen in the first place? Well, human beings, we are naturally pattern seekers, and the world as we know it is full of randomness, which the human brain does not often like. And so at the same time, people who like to charge in their own destiny and have a self-determination path, and as a result, random events happen. People are very likely to misattribute those events to something that they themselves have done. Hey, number one. So how does random reinforcement influence traders? We talked about how it may influence life. How does it directly influence you and me as traders? Well, there's two primary ways that random reinforcement manifests among traders. The first is that it can give a novice or unskilled trader a false sense of security, right? False sense of ability, and then the past outcomes, you know, are actually due to chance alone. That's the fact for most beginners. The second way is that a string of bad luck can influence an otherwise skilled practitioner and give people some doubt and give people some fear. And the worst part is that it could force them to abandon a really good strategy. So how can one protect himself from the effects of negative biases of random reinforcement? Well, once we realize that the randomness can create strings of losses in a great trading plan and strings of profit in poor trading strategies, once we realize this and understand it in our minds, we put forth all of our energy into creating a strategy, a good strategy, and then we adjust it accordingly. Each trader should maintain a well-written trading plan that outlines how trades will be made, why, and when. And also it should have money management rules. It should be clearly spelled out, reasons for entry and reasons for exit. And in this way, the trader will know over the long run if their plan is flawed, if they have, you know, some form of success, and they have an objective way to measure these things. This is the key of this webinar, the key of this video that I'm trying to get across to you. So the bottom line is that the markets are extremely dynamic and in a constant flux. This brings in an element of randomness that can create pockets of profits for unskilled traders and losses for skilled traders, and it happens all the time. A trader must also determine when a certain string of losses or profits can be attributed to their skill or to randomness. So the only way to do this while you're learning is to approach the market with a good trading plan. And we here at Olymp Trade actually help you guys put together this complete wholesome plan. And then you need to risk a small percentage of your capital in each trade. This way a trader can see and monitor how they perform, and also over the long run randomness becomes less and less of a factor. It's also important to remember that even the best traders and trading methods experience strings of losses, and this is not a good reason to abandon the strategy. However, isolating why the method is no longer working and trying to find out why may lessen the extent of the losses you may incur when similar adverse conditions happen to us again. So this has been the story of the biggest mistake we all make in trading. I hope that this video helps you think about trading from a different perspective now, and I hope that once you begin to control this random experience that happens and you start to understand that maybe you got lucky, maybe you're doing something wrong, you will then start to work on improving and increasing your consistency, stability, and discipline. We are here to help you guys with all of that. Come back to our channel. Subscribe if you haven't done so already. Leave a like, a thumbs up helps to circulate the video around the internet. And come back to our next video, which we'll have for you next week, where we will talk about how you can earn $1 million trading, what the quickest way is to do that, and also we will have the Heikin-Ashi explained to you so that you can trade like a Heikin-Ashi ninja. So my name is Yaroslav Burchenko. Together with Olymp Trade, we wish you guys good luck trading out there. Thank you for your time, and see you all next time. Peace!